Good evening. We are looking at today's session, the pilot paper what had been released by Institute, pilot paper question number 1. So the today 2-hour session we will be looking at question 1 and 2. I am sure all of you all would have seen the pilot paper, and there is a suggested answer also given in the website of CA. So you could go through the question and answer. So what I am going to do is explain you the question content, what exactly the requirements are, and try to show what the answer had been given, and we discuss on that. So starting on the question 1, actually it's about a company called Beta PLC, and they are talking about directorships and the return on assets. This may be relevant to us. Return on assets is 16%, return on equity is 30%. So they have given you the two returns, and they have said few things. For example, one, board approval, they are talking about board approval has been given to lend 200 million to sister company. 200 million has been given to sister company, or they are approved to give 200 million to sister company at the interest rate of 10%. In addition, they mentioned that the sister company is facing liquidity and debt problems, and some of the non-independent directors were concerned about this loan, even though the CEO has highlighted that the company has free cash flow of 300 million, and therefore this decision will create value to the company, and you can use the free cash flow. This is one of the things they have mentioned. In addition, the company has given approval to refurbish the office, which will cost company 80 million rupees. Refurbishing office, so 80 million rupees. Again, it's through a related party. The refurbishment work has to be given to a related party, and one of the executive directors of the Beta PLC is also a director of that related company. So that two information is given. Then they are talking about microfinance loan. They have a business micro loan business also, where they say 50,000 rupees loan can be given, and 12 installments the customer have to pay, 6,000 per month you have to pay. Then they are talking about another business the company has, which is assurance services, and they are given you the benefit plans, of which particulars are given there, plan 1 and 2. There are two plans they are talking about, which involves payments of annual premium by the customer for some time. After that, the customers are able to get retirement benefit for the balance period of time, which is mentioned in the question. So these are the information given. In addition, if you look at those are the question information. Then when you go to look at one by one the question, A part is asking you what is the yield of the proposed micro loan. By micro loan yield, what do you mean yield? The terminology yield is the return. Your return, what you are going to get from the microfinance loan. And it's a microfinance loan is talking about 50,000 rupees loan, 50,000 rupees loans. That means each customer will be given rupees 50,000, and it will be repaid in 12 months, and the 6,000 rupees is the per installment value. 6,000 rupees. So it's a simple information, a loan which is having 6,000 rupees repayment for 12 months, and the loan is 50,000. That's called microfinance loan or micro loans. And they are asking you what is the yield of this loan, yield of the loan. Always remember, the yield is the return of the instrument, So the yield is the return. Return is actually forming the name as the IRR. Internal rate of return is the return of any instrument. So any instrument you can take. It can be a debenture, it can be a government security, it can be like a microfinance loan or even a project. If you take a return, the return is actually the IRR of the instrument. So here we are talking about 50,000 rupee loan, customer has to pay 6,000 per month for 12 months. So what is the implied return of this instrument? Now if you simply look at it, you are going to pay 6,000 rupees into 12 months, that is 72,000. So 50,000 loan, the customer will be repaying total rupee value of 72,000. So we obviously know that 50,000 loan, you are paying 72,000, there is a return involved. The 22,000 amount is the return of the instrument in terms of value. But what is the return percentage? That is the yield. So how do you calculate? It actually, any instrument if you want to calculate the yield, it's about your IRR. So you need to calculate the IRR of this loan transaction. Here it's not about 5 or 10 year project, here talking about 1 year, but it's monthly installment. So what's your IRR? So if you look at your solution, I think in your solution they have calculated the IRR. IRR is, they are talking about the calculation. You can use it in your calculator or it's in the IRR form. If you can do the calculation, you will see that your answer is 73.32. That is actually 6% something, 6% something you are going to get for a monthly installment return. Then you are talking about 12 months, so 73% your return. So if you look at this micro loan 50,000 with the 6,000 installment, you are talking about 73% roughly, it's your IRR, which is your yield of the instrument. So how do you calculate? It's basically your IRR calculations. I am not doing the calculations here, I am just explaining you the IRR calculation. You can take 12 months cash flows, you can take your 12 months cash flow. So if you are taking a customer, he is saying month 0, 50,000, then you are talking about month 1 to 12, you are talking about 6,000. So the loan customer who has taken the loan, he has received and he is paying 6,000 for 12 months. So what is the IRR of this instrument? That is 73%. You can calculate it from a IRR formula or the financial calculator. So that will give you an idea that this loan earns a 73% return. Generally the microfinance loans, which are not like normal commercial loans in the bank where you talk about term loans or even the personal loans, those are very lower rates charged because the risk of that loan is very lower. Please understand, risk of the loan is lower. So the banks also, the finance company also charges a lower rate. So generally if you take a term loan, you may be able to get 15%, maximum 15% at today's context, you can borrow at 15%. But if you take a personal loan, if at all the worst scenario, you can say 20% you could borrow money, even that is also lower today's context. But if you take a microfinance loan, the rates are not at that levels. It's very expensive because there is no security provided by the customers. So it's purely based on your cash flows and your business. If it survives or if you are doing very good, then you get your return. Otherwise you might lose your capital also. Therefore the company who is financing, bank or finance company, knows that risk. Therefore they charge us very, very high rate. It's not a normal banking loan returns, it's very high returns. At the same time the risk is very high. There may be possibility of your capital becoming bad compared to normal bank loans. So that is the reason why the charges are or the returns are very high for the loans. So the first part is that you are calculating the yield of the instrument or the IRR of the instrument. Second one, comment about the yield calculated in A above by comparing with ROA and ROE, return on assets and return on equity of this company. Return on assets and return on equity of this company. Return on assets of the company is 16%, return on equity is 30%. So we need to understand that 16% return on assets, return on equity 30%. 16% return is for the entire funds, entire capital what you have invested in your business, which is generating 16% return of operating profit. But return on equity, that is return to the shareholders only, is 30%. So we all know that this can be more than, return on equity can be more than return on assets if you can borrow money and invest. That will come to that in another part of the question. But here the question is asking, what do you see compared to these two, this 73%? microfinance loan giving is a one business of this company, one business. But there are many businesses this company do. So when you take many businesses, total businesses return is 16 and 30 ROA and ROE. Whereas microfinance one is giving you very good return of 73%. So what we have to understand is, even though one business model or one business segment giving you 73% or very high rate of return, your overall returns are in this range, That highlights that other business segment, it can be your insurance services or maybe other whatever business you are involved, it can be giving you returns lower than your 73%. So when you say you mix up all the returns of the businesses, all the businesses profitability, you will realize your average return is what you are talking here, 16 and 30 ROA, ROE. So the reasons they are asking, comment about the yield calculated in A above by comparing with ROA and ROE. The answer is ROA, ROE are for the entire or the total business segments, or total segments of businesses, you are getting 16 and 30, whereas only one segment which is giving you 73%, which is the microfinance loan. That means all the other segments are giving you very lower return compared to this. So it can be maybe at 10%, 12%, 13% returns you are generating. Therefore, when you mix up this microfinance loan business with the other businesses, your average returns are falling into this range. So that's basically the comment we have to make. C part, discuss whether the board decision is to lend money to a sister company and to refurbish the office premises would align with the objective of maximizing the value of the company. So there are two loans or two things they are talking here. One is about a loan giving to a sister company, which is undergoing liquidity problem and debt problems. Other one is you are investing in a refurbishment of office, 80 million rupees, but it will be done through a related party. So these are two transactions you are talking about in the case or the question, and they would like you answer whether that decision, whatever you are making, 1 and 2, 200 million one and 80 million second one, whether it is aligning with your objective of the company. Please understand, all the organizations, the primary objective is to create value for shareholder. Your value creation is your objective. Your key value creation, key objective is a value creation. So to do that, whether these two transactions will be aligning with that objective. Firstly, we need to understand that these two transactions are related party transactions. These two transactions are to some extent related party transaction. One, of course, they are very clearly say it's a related party. Second one, if you take the 200 million, is a sister company. So it's a related party transaction. So RPT. And refurbishment office, it's again a related party transaction. So that also they mentioned. So if you are going to give loan to a sister company at 10% related party, always remember there is a conflict of interest. That means you may be doing the transaction because it's a related party. You may be doing the transaction. Second thing, when you do related party transaction, the transaction may not be on fair terms or the arm's length terms. So that's a possibility you may do the transaction not at fair arm's length. You might be charging lower rate like here 10%, or you may be doing a office premises building at a higher cost. So you can do that transaction, or it can be other way also. You will be giving the loan at very high rate, or you will be doing the building at very lower cost. So because depends on other party's objective also, since it's a related party, you might do transactions which are not on an arm's length basis. So please understand, the conflict of interest and arm's length basis you might not do. Arm's length basis you might not do the transaction. So this is one of the concern of related party transaction we will look at. But in terms of maximizing value for shareholder. This is one concern. The related party transaction will result in conflict of interest, and then arm's length basis you may not do the transaction. This is a concern you will have. But apart from that, creating wealth for the shareholder, whether this transaction will create wealth for shareholder. One, related party transaction 200 million giving to a sister company 10%. 10% loan, is it sufficient return from your company point of view? If you are giving the loans, or if you are doing a transaction normally in the market conditions similar to 10%, then your transaction is fair arm's length. Otherwise, you are not creating wealth for your shareholder. You are destroying wealth for shareholder. So you need to see that the 10% is something which is your arm's length basis you can give. I don't think because your ROA is 16% and ROE 30%, so you obviously your return what you can make from business is more than 10%. So if you can make more than 10%, if you are going to give it to your sister company at 10%, that means you are not doing the transaction at arm's length basis, which means you are not creating wealth for your shareholder. So that is something you need to comment about. In addition, there is another point you have to talk, which is it's about a sister company, and that company is going through a liquidity problem and debt problems. So since it's a related party and a liquidity that concern the related party company, if it is going through difficult times, you may have to help that company because it's a company, right? So we don't know the ownership structure, right? So you need to understand that there is a need for you to support the company. So if that is the reason, you might see at the board whether it's really we need to give this loan so that we create wealth for the shareholder on the long run. So that is something you may have to consider, but in terms of number, 10% is lower than your normal returns, so definitely you are not going to create wealth for the shareholder, you are in a way destroying wealth for shareholder. Refurbishment office, 80 million. This is again, you are going to give it to a related party. So if your transaction is going to be on arm's length basis, then it's not an issue. At the end of the day, somebody has to do this office refurbishment. If it's a needed thing, then you have to do the refurbishment. So the question is about the amount involved, whether you are charging or whether you are paying more than the required amount. If it's actually transaction value is 50 million, you are paying 80 million, then you are destroying wealth for the shareholder. Otherwise, if it is arm's length basis, you are not having a problem, you can go ahead with your related party transaction, provided it's at arm's length transaction. So this is basically the question is asking whether board decision to lend money to sister company and refurbishment is aligned with the objective of maximizing value. Yes, it is going to create value provided this transaction is done at the arm's length basis. But first one, of course, we can definitely say it's not at the arm's length basis. Because 10% is something very lower than your return on assets or return on equity. So you have opportunity cost is, your opportunity cost is more than 10%, so no point in giving at 10%. So this is actually destroying wealth. Second one, you can't conclude, but you know that it's a related party, so there is a possibility of your value is not at arm's length basis. So you need to double check whether it's at arm's length basis. If it is arm's length basis, you may go ahead with the related party transaction. Okay. D part. So D part of question. What is the D part of the question? D part is asking you, explain the reasons as to why ROE of the company is more than ROA. ROE of the company is more than ROA. ROA is 16, ROE 30. Actually, this is a good question. I would like to explain a little more because it's about the benefit of gearing. Benefit of gearing. The objective of gearing means that you borrow money and invest. The objective of gearing is to increase return to shareholder. For example, say your company is getting money or the capital from equity, say 100 million and debt 100 million. Total 200 million. The company has got 200 million from equity 100, debt 100, 200 million. And debt holders, their required rate of return, we will just put it, required rate of return, debt holders wants 10%. and shareholders, equity holders want 20%. This is what they are wanting, what they are expecting. This is a 200 million money the company has got from these two investors. That 200 million you invest, and the return on your investment, say you are talking about 20%. Your return on investment is 20%, which means how much you are going to get? 200 million, 20% return on investment. Your operating profit, your company will be making 40 million. So please note, your company has got 200 million capital, 100 million shareholder money, debt holder money 100 million. And the debt holders are the bank, for example, they want 10% return on the investment. And the shareholder given money expecting a return of 20%. That 200 million you are investing in the project or the company and earning 20% return. That means you are earning operating profit of 40 million. Operating profit is EBIT, right? It's before the interest. We consider tax for time being, we leave the tax for time being. Operating profit is 40 million. Out of 40 million, you have to distribute to equity holder and debt holder. Firstly, we have to do the debt holder contribution because they are the one priority creditors, we have to pay them. They gave 100 million, they give 100 million, and how much they want? 10%. So you have to give out of 40 million, debt holders, how much? 100 million into 10%, 10 million. You give 10 million to debt holders. How much you are left with? Shareholders, you are left with 30 million. Shareholder left with 30 million. That 30 million, you can give it to shareholders. You are giving to shareholder 30 million. How much shareholder put the money? 100 million. So shareholder put 100 million, they are going to get 30 million. That means how much return shareholder will be getting? 30%. Shareholder is getting 30%. Debt holder how much he is getting? 10%, which they want, and you are giving 10 only. Debt holder very clear, documented, 10% return, 10 million he will get. Shareholder will get 30 million, which is 30%. So if you take the actual return from this project, debt holder 10%. No problem what they want, they are getting. Shareholder gets 30%. Shareholder gets 30%. Now if you really look at, the return on assets is 20% in this example. Return on assets is 20%, shareholder return is 30%. How much shareholder wanted? 20, but you are giving 30. How did you give 30? How did you increase that 20 to 30? Simply because you borrowed money at 10%. So what you have done? You have borrowed 100 million, 50% of capital at 10%, and you invested in business, that gives you how much return? 20%. So the 100 million you borrowed from somebody, bank or somebody at 10%, and you invest and earn for that 100 million also 20%. That 20 million, you pay 10 million to the debt holders, balance 10 million, shareholder didn't put any money for that 10 million, but he will get 10 million. So if you realize, he gets 30%. So the shareholders' return has gone to 30% simply because you borrowed money at a lower cost than the return on assets. This is called gearing. This is called gearing, where you borrow money and create more return for shareholders. You borrow money and you create return for shareholder. So you need to borrow at a return or the cost lower than your return on investment. As far as your return on assets are more than your cost of debt, definitely the gap will go to the shareholder. He is able to get more return. This is called leveraging or gearing. Same thing, coming back to this question. This is only an example I am just taking to explain you the gearing process. And here their question is asking, why return on assets is 16, why return on equity is 30%? What is the answer? The answer is, company has geared or borrowed or leveraged, company has leveraged, geared and leveraged, and return on asset is more than cost of debt. The company should have borrowed money at a cost which is cheaper than return on assets. So when you borrow money at cheaper and invest and earn more than cost of debt, then automatically return on equity will be return on asset. This is the example you can think of, right? So this case also, they have said 16% return on assets, but you earn return on equity of 30%. So similarly here, return on asset is 20%, but return on equity is 30%. So please note, why the return on equity is more? Because company was able to borrow money at a return, at a cost, that's cost of debt, cheaper than return on assets. Since the return on asset is more than cost of debt, you are able to create more return for shareholder. Then finally, return on equity is more than return on assets, as you see here. So this is basically the reason for why the ROE is more than ROA. So please note this. This is the D part. Then can you read the E part? E part. So E part is actually 10 marks question out of 25 marks. 10 marks is for E part. Can you read that question? Evaluate. They have given you assurance services or one of the business segment of the company. Evaluate both retirement plans. By comparing present value of retirement benefit offered, present value of the retirement benefits offered. Retirement benefits are offered to customers. So they want you to calculate present value of retirement benefit offered to customer. You have to compare that with the present value of annual premiums paid. Annual premiums are paid by customer to the company. So please understand there are two sides of it. One is company side, other one is customer side. First one, present value retirement benefit offered is company is paying the customer after a certain amount of years, you have to pay retirement benefit to customer. Here, present value annual premium is customer is paying at the beginning to the company. So if you take the question, Plan 1, you can see annual premium is 1 million. The customer has to pay the company 1 million annually. Annually customer will pay the company. 4 years he has to pay, and the premium to be paid at the beginning of each year. So if you are talking about cash flow, here year 0, 1, 2, 3. So there are 4 years, but beginning of each year you are going to pay. So the customer point of view, you will be paying 1 million for 4 years. Year 0, 1, 2, 3. Why? Beginning of each year. That means first year beginning is year 0. Second year beginning is first year. Third year beginning is second year. Fourth year beginning is third year. So always remember that this is, when you say first year, this is end of first year. Second year means end of second year. Third year means end of third year. So beginning means year 0 is the first year. Year 1 is second year. Year 2 is third year, year 3 is 4 year. So these are your 4-year period customer is paying. So 1 million customer will be paying like this. So they want you to calculate present value of the retirement benefit offered. So first of all you need to calculate that. Then they are talking about the premiums are paid only for 4 years, but the policy term is for 10 years. So your policy is there for 10-year period. So customer is paying us 1 million per 10-year policy period. And the retirement benefit you are paying to the policy customer. Retirement benefit is what you are going to pay to customer, right? That will be starting from 15th year. Sorry, it will be starting from 10th year end and going for 15 year. So this 4 year you got the premium from the customer, and it goes till say year 10. Till year 10 the policy is valid. After that you start paying retirement benefit. For how long? Year 11 to, you are talking about 15 years you are going to pay. So 10 to 15 means 10 years to another 15 years, 25 years. So 11 to 25 years you are going to pay retirement benefit for customer. And the monthly amount of payment you are going to make is 70,000 rupees. And the assumed interest for this whole thing is 8%. 8% is assumed interest. So this is basically the information for plan 1. What we are doing here, the business, insurance business, or assurance business, The customer will be paying 1 million for year 0, 1, 2, 3. That company is going to receive money. And the policy is valid for 10 years. After 10 years, company has to pay the insurance, or what the company we are talking beta has to pay retirement benefit of 70,000 rupees for how many years? 15 years. Monthly payment of 70,000 for 15 years the company has to pay to customer. So these are the cash flows involved. So they are breaking the cash flow into two. One is retirement benefit offered. Retirement benefit offered is this 1 million. That is, sorry, retirement benefit offered is the second part. That is 10th year end to 25 years you are going to pay. Annual premium paid is what you are talking about here, 1 million. So can you take your suggested solution? Suggested solution. Suggested solution, if you go to look at it. Plan 1, you can see the question there. Present value of benefit offered after 10 years or 15 years. So first of all, they are calculating present value of retirement benefits, that is 70,000 rupees. I can think that you are seeing the suggested answer. It's a 70,000 per month you are going to pay for 15 years. So the retirement benefits offered is 70,000, 15 years mean 180 months. So what you have to calculate, 70,000, 180 months you are going to pay, and implied rate is 8% per annum. So you need to calculate the present value of 70,000 rupees for 180 months. 180 months you have to calculate present value of this. You will cut the present value by multiplying the annuity factor. You can get the 70,000 into annuity factor. You get your present value, but the present value what you get is end of 10th year. Why? From these to the 25 years, if you say 25 years, this period cash flows present value you get at year 10. So your present value what you are getting by multiplying 70,000, 180 months, 8% annuity factor, what you are going to get is present value as of year 10. Then what you have to do? You have to bring the year 10 to year 0. Rediscount that to year 0. That's what your answer you would see. 7.3 million. 7.3 million is what we are talking, the present value of this cash flow. Present value of this cash flow is 7.3 million. 7.3 million is the present value of 10 years. But since your present value is at the end of year 10, to bring it to year 0, you have to bring it to year 0, you rediscount at 8% for 10 years. So you rediscount at the discounting factor, 10th year at 8%, that will give you 3.3 million. So we are talking about 3.3 million is the present value of retirement benefits, what you are going to get. So this is your first part of the answer. Second one, the 1 million payment. 1 million payment what the customer is going to pay us for 4 years. So we have to calculate that 1 million payment at the end of 4th year. Actually it's not at the end of 4th year, end of 3rd year, because only 4 payments and you are starting at the beginning of the year. You calculate that, then you will get your value here, future value. That future value you need to calculate again at 10th year. Why? Your policy period is valid till 10th year. So till 10th year, what is your future value will represent. So you can look at the answer there and the suggested answer. The 1 million for 4 years, it's 4.8 million. After that, it's 6 years, over which no premium is paid. Total policy period 10 years. You will see that 7.7 million is the future value at the end of 10th year. That 7.7 million, you have to bring it to year 0. Like here, what we did to bring it to year 0. Even this, you bring it to year 0. So you bring your 7.7 million to year 0. So both of these, you are bringing to year 0. So your numbers you can work out anyway, but what understanding you have to get is there are 2 transactions. One is the customer paying us 1 million each year for 4 years. So that money, how much will be the present value? So that what he has paid, you calculate the 4th year present value or future value. Again you calculate that value to 10th year future value. After that, that value you bring it to year 0 present value. Year 0 present value. I think here the present value is 3.5 million. 3.5 million. Similarly, what we are paying to customer, after the 10th year, we will be paying for 15 years the customer's retirement benefit. After 10th year, we will be paying for 15 years retirement benefit to customer. So how much is the present value of that payment that you are going to pay to customer? So what we did, we calculated the 15 years cash flows present value that we arrived at year 10 end. Again we bring it to year 0 because your present value what you got from the annuity factor multiplication year will be at the end of year 10. Again bring it to year 0, rediscount it and we get 3.3 million. So what I am trying to say, you are comparing two present value as of year 0, and you can see that your money what you received 3.5 million whereas you are paying 3.3 million. So almost 200,000 will be the value creation from plan 1. Plan, it's not 200,000, 184,000 is the gap between these two present values, that will be the value creation. Since your premium what you collect from the customers, that present value is 3.5 and this is 3.3. So you have a value creation for company. Company point of view, you are creating wealth of the gap between these two. If it is the other way, this is 3.3, that is 3.5, you are destroying wealth for the company. The transaction is not benefiting the company. That is plan 1. Then moving to plan 2, I would like you to look at your own calculation. You calculate your numbers, understand the principle because you are not going to get the same question in the exam hall. But you have to understand that there are two payment streams. This payment stream is for 4 years. After that, we don't have any payment or the customer is not paying anything. How much the present value of that money, what we are going to get? So this money what we are getting from the customer, you are basically calculating the future value for 10th year. That future value, you bring it to year 0 and say how much the value, present value. Similarly, the 15 years payment that you are going to pay customers, we are bringing to year 0 again as a present value. Both present value we compare and say whether you are creating wealth or destroying wealth. That's basically the transaction. Plan 2, same thing, same process. Always remember that it's more than the number what you are getting. 3, whether your concept you are clear. It's about again simple multiplication, present value calculation, future value calculation. As far as you are very clear in how do you do the annuity factor multiplication, discount factor multiplication, your formulas are very clear and your calculator you know how to use it, then there is nothing here serious. It's simple calculation. Only thing you need to be very clear, there are two payment streams. One is customer paying us, other one we are paying to customer. Both case we want to bring it to same time to compare the present value. So you can't stay at the 10th year and compare the one present value with another 15th year present value. You have to bring both to same year, that is year 0 present value and compute. So in plan 2 they are talking about benefits are offered after 16 years for 10-year period. 16 years for 10-year period. So 50,000 rupees. So they are calculating for 10 years, 50,000 rupees for 120 months. 120 months. Since it's a monthly installment, you are talking about 8% divided by 12. That is actually 0.67%. So these are the information you are aware of. 50,000 payment, 120 months, 0.67. So you can calculate the annuity factor and multiply your amount. Plan 2, am I going to? Plan 2, again going back to the question, plan 2, annual premium is 200,000, that is the customer paying us for 16 years. Policy term is again 16 years. Monthly retirement benefit starting after policy term 50,000. Monthly retirement benefit starting after policy term 50,000. So 50,000 is starting after 16th year. So actually your 17th year only the 50,000 you have to pay. How long you have to pay? For another 10 years. So we are talking about 17th year to 10 year mean almost 27th year or 26th year. 26th year you will be paying. So you are going to pay for 10 year period. 10 year period means 120 months, 50,000 rupees at 0.67 rate, monthly rate. So that's basically your cash flow going to be. So if you take the suggested solution, you are calculating the present value. Same exercise what we did earlier for the plan 1. You are talking about 50,000 rupees, 120 months. This is your 0.67 is the rate. So you calculate your annuity factor, multiply by 50,000, that gives you a present value. But the present value what you are getting, will be at the end of 16th year. Since your present value is at the end of 16th year, present value what you are getting from this calculation, here what you are doing 50,000 rupees multiplied by annuity factor. So whatever the value you are getting, say X amount you are getting. That X amount again you rediscount because you are at the end of 16th year. Your present value is at the end of 16th year. So again you bring that X into year 0. Rediscount at the same 8%. So that's basically done there. So you could see that present value of the payment that you are making to customer is calculated on one side. Other side, what we receive from the customer, what we receive as a premium from the customer, which is 200,000 for 16 years. So they are calculated 200,000 for 16 years. They are calculated as annuity and they get the 16 year value, that's future value, since you are going to pay 200,000 every year. So we are calculating the future value of this annuity, that is giving you 6 million rupees. 6 million you are rediscounting at 8% to year 0, that gives you 1.7 million. 1.7 million. So in the, as per the calculation done here, 1.2 million. 1.2 million is the retirement benefits paid. What we are paying to customer, retirement benefits paid to customer. 1.7 is the premium what we are collecting from customer. Premium collected from customer. This is from customer. So please note, what we are collected from customer, that all future values, present value is 1.7. What we are paying to customer, that future payments, present value 1.2. Then we are talking about 0.5 million plus. So we are creating 500,000 rupees value compared to plan 1 which had 184,000 value. So which option is better? Plan 2 is better than plan 1. So that's basically the 10 marks question, where simply you are playing with your present value calculation and future value calculation. So your knowledge needs to be there very thorough. How do you calculate present value? How do you calculate future value? Then moving from there, question number again 1, question number 1, F part. F part. E part is a 10 marks question. We attempted. We got the present value of the two options and found out which is better. F part. F part is asking what is the time value of money in plan 1? What is the time value of money in plan 1? For beta PLC, premium collected can earn the same rate as assumed interest rate during that period. So they are asking what is the time value of money. So going to the suggested solution. So you can see there, it's your future value of the premiums paid by the customer and present value of the premiums paid. So what is the time value of money? Your future value and present value difference is your time value of money. Right? Year 0 value and the future value. Future value, how much is going to be? 14 million for plan 1. And the present value of premium paid is 3.2 million. So time value of money is 11 million according to calculation. So it's basically, please understand, any stream of cash flow, year 1, 2, 3, you might have say 10 million, 10 million, 10 million, and you can take the year 10, all these cash flows with the interest, accrued interest, you can calculate future value, year 10. Same time, year 1, 2, 3, 3-year cash flows. We can calculate year 0's present value. These are only 3 cash flows. These 3 cash flows we can come backward or can go forward. Same 3 cash flows, future value how much? You can calculate. Or same 3 cash flows, you can calculate present value. The gap between present value and future value is called what? Time value of money. It's actually the time period between these two differentiate the value, or the rate, basically the rate what you are talking, 8% is the return for the monies what you are talking here. So these 3 cash flows, present value can be X amount and the future value of the same 3 cash flow can be Y amount. So X and Y, the difference is called time value of money. So that's basically the F part. Last one on the question number 1, what would be the reasonable value that a customer can place in life assurance and other benefits if or she opts to invest in plan 2, assuming that the required rate of return during the entire period is 8%. So the customer point of view, how much is the value he is going to place on the life insurance. So please note, customer's point of view, we are calculating how much the value he is going to get. The present value of the premium paid, customer's payment is 1.7 million. Present value benefits obtained is 1.2 million. So it's the difference between your premium paid 1.7 million and the premium benefits obtained is 1.2 million. So reasonable value of the insurance benefit is 567,000. The gap between the premium paid and the benefits obtained. So this is basically the difference. It's actually giving you the customer can place in life insurance, how much the value he is placing. So he is placing a value of life insurance. Please understand that the amount of money you have paid excess, because your benefits what you are going to pay is 1.2 million. You need to, I don't know whether you are getting it clear. 1.2 million is the benefit as a customer you are going to get. Your value in monetary terms, your value is 1.2 million. Whereas the premium what you have paid, that present value is 1.7, which means you have paid more than this what you are going to get. The 500,000 is more. Why the 500,000 you paid more? That is why you are that is what the payment you are making to get the life insurance cover or the life benefits that you are going to get. So the life insurance benefit, whatever they are talking, life assurance and other benefits, whatever you are going to get is worth 500,000. So please note that you are paying for the risk what your life cover has. That cover is 500,000 you are paying. It's not profit making business in insurance. You have to understand that you have a life risk that is also covered in that process. So the 500,000 what you are paying is for that purpose. Okay. So that's your question number 1. So what you really got from the question number 1? The question number 1 add few things to be looked at. Major portion is about your your fundamental learning, which is your discounting and compounding, right? Present value is about discounting, and future value is about compounding. So please understand, the question is mainly on the present value and future value calculations, and your discounting factor, here you are talking about discounting factor, and here we are talking about annuity factor, the future calculations, and we are talking about the time value of money difference or time value of money calculation. This is one main portion of this question. Second, they are talking about your gearing. Gearing, even though it's a slight smaller portion in the question, to be honest, that should be the more weightage than this kind of question, I would say, in the suggested question. But gearing is a very large area, and it's very important from the practical corporate world. Gearing syllabus also has higher weightage. Gearing point of view, your ROA and ROE, why the ROE is more than ROA. So that we looked at. So that's one area they have tested. Third one is about your whether you are creating value by giving at 10% return to your sister company. So that's basically a value creation related aspect. Fourth one, your simple IRR question. So these are the area tested on the question number 1. Okay. So please understand, this weightage that was given for the 10 marks is very high, right? Even though it's very high, you may have to understand your basic calculation, because there could be better area of testing in the question than just multiplying the discounting factor and annuity factor. I would rather say that would benefit the people. Okay. Okay. So that's your question number 1. Then when going to moving to question number 2, question number 2, it's about alpha. It's about Alpha PLC, it's a listed company. They have given you, it engages in manufacturing and trading of food and beverages in local and international markets, and the company is stated capital, retained earning, total equity, bonds. Bonds are incorporates, the bonds are debentures. They have given you the values as of 31st March over the last 5 years. In the question, they have given you 5-year stated capital, retained earnings, total equity, bonds. So you are being given the equity capital and debt capital of the company. 2016 and 17, it's only equity capital company. 18, 19, 20, it's a combined, the equity and debt capital. And accounting year of the company is 31st March. Accounting year is 31st March. They have given you. Accounting year is 31st March, and they said the bond has been issued. Bonds are the debentures that have been long-term instruments have been issued at par value, and will mature on 2025 31st March. So please understand, the bond is maturing 31st March 2025. So this is your maturity period. Bond is maturing on 31st March 2025. So we are now in 2020 March. So the question is as at 31st March 2020. So we are in 2020 and the bond is maturing in 2025. So the 5 years to go. But actually the bond was issued when? 2018. 31st March balance sheet as bond value. 2017-16 no bond value, 2018 March asset. That means you have issued a bond in 2018 and it's maturing in 2025. So ideally if you look at it, it's a 7 years bond. 7 years bond. 7 years bond. But as of 31st March 2020, that is where we are now, we have 5 years to go. 5 years to go. And they say that coupon rate of this bond is 12%. Coupon rate is 12% per annum and the interest is paid semi-annually. So the interest is paid 31st or 30th, they are given 30th March and 30th September. So it's a semi-annual coupon. Semi-annual coupon. So you are paying semi-annual coupon rate, that means 12 means you are paying 6% a year, 6% a year, or otherwise 12% you are paying for 6 months and 6 months. So if you take the value wise, I would say you are talking about bond value of how much? Your par value is say 100 rupees. So you are talking about 6 rupees, 6 rupees you are going to pay your dividend, sorry, interest for the period. So your interest will be 6 rupees in 30th March, 30th September, 6 rupees. They say that these bonds were traded, that means traded in the market 107% and 90% on 31st March 2019 and 2020. So 31st March 2019, that is last year, and 2020, that is this year. The bond had been trading at 107. Last year it was trading at 107 and now it's trading at 90%. So if you take it, the debenture value is 100 rupees. If you take the nominal value of the debenture is 100, you have been trading, or the debenture had been trading at 2019 March at 107 rupees. 107% of 100. 107%. 107 rupees you have been trading. 2020 March, that is where we are, it's trading at 90%. That means 100 rupee debenture nominal value trading at 90 rupees. So these are two market value of or fair value of the debenture as of two dates they are given, 2019 March, 2020 March. However, the trading value of the company were insignificant. Even though they are given you the value, fair value, those are not very much traded in the market. Analysis of the term structure, the interest rate of the country reveals that interest rate applicable for 5-year maturity would be around 10% mainly due to the proposed policy measures by the government. So what they are saying is as of now, when you look at the term structure means the relation between interest and the term period of the instrument. 5-year maturity as of now, if you look at the market instruments, they are giving you 10%. So the 5-year instrument today gives you 10% return. 5-year instrument as of today gives you 10% return. However, it is unlikely that the interest rate would prevail at the lower interest rate due to market pressure, and experts say the possibility is there to go to 20%. So even though there is a one side of story to say that rate can be for 10% 5-year maturities, there is another story saying that the rate cannot be at very lower rate, it has to move forward, it may achieve to 20%. So these are information given in the question. Then they are given you 5-year dividends, 2016, you can see the dividends given 2016 to 2020, 2016 to 2020. 2016 20 rupee dividend, 2020 2 rupees and 40 dividend. Now if you really read the other two lines, stated capital 31st March 2020, 10 million ordinary shares. The company has 10 million ordinary shares as of 31st March 2020. That is now 10 million shares the company has. Shares of the company were split in March 2018. Now we are in 2020, 2018 the shares were split in the ratio of 10 for 1 share. Which means if you have 1 share, splitting means what? Instead of 1 share, you will have 10 shares. The company will issue 10 shares certificate to you for 1 share certificate. So you take the 1 share out and give you 10 shares. So now you are owner of 10 shares, not 1 share owner. That's basically the share split. Now you need to ask the question why the share split happens. Share split is done for the purpose of increasing the liquidity of the number of shares. So in order to increase the liquidity in the market, you issue or you give the share split. So actually the share split does not involve cash transaction. Right issue involve cash transaction. You are issuing shares to the existing shareholders at a price lower than market price, where the company will get more cash from the shareholder. But share split, it's only a book exercise where the company secretary department will issue shares, 10 shares for 1 share. So it's only a number of shares change, If your stated capital is 500 million, earlier we looked at 500 million stated capital, please look at it in your table. The 2018 500 million stated capital, 2019 500 million, 2022 500 million, 2016 500 million. That means no change in stated capital. No change in stated capital. Now we have 10 million shares. We have now 10 million shares. What would have been the number of shares we had in 2016? Now we have 10 million shares after share split. We are given 10 for 1 share. That means it's not like right issue where you hold 1 share, I give you 10 shares. No. If you have 1 share, cancel the 1 share and give you 10 shares. So how many shares we have now? 31st March 2020, 10 million shares. Now we have 10 million shares. What would have been there in before the share split? 1 million shares. So we add 1 million shares. After share split, we have 10 million shares. So 1 million shares have become 10 million shares. Please note that 1 million shares has become 10 million shares. So stated capital, please look at your balance sheet, no change, no change. There is no cash transaction, it's only the number of shares changes. 1 shareholder will get 10 shares. So what's going to change? If you say your number of shares are changing from 1 million to 10 million, your earning per share, if you have X amount here, that earning per share, now you are dividing not by 1 million, by 10 million. So your earning per share become small number compared to earlier number. Dividend per share. Dividend per share again will be small number now than earlier. Why? Now we have 10 million shares, earlier we have 1 million shares. So please note, now going to your dividend per share, I just take your dividend per share table. 2016, your dividend per share is how much? 2016, dividend per share is how much? 20 rupees. Same dividend per share, 2020, same dividend per share 2020, 2 rupees and 40 cents. Now you cannot compare 20 with 2.4. If you to compare 20 rupees in 2006 dividend we got, 2.4 only we are getting, that is very low and you are losing. No. 20 rupees dividend per share mean how much the total dividend you paid in that year? Total dividend. 2016, how many shares we had? How many shares we have? How many shares we had in 2016? 2016 we had 1 million shares. 2020, how many? 10 million. 2016 we have 1 million shares. 2020, 10 million shares. When we have 1 million shares, we paid 20 rupees per share. Dividend per share 20. 1 million shares when we had, 20 rupees we paid. That means how much you have paid dividend? 20 million. Now we have 10 million shares. Now we have 10 million shares. How much you are paying dividend? 2020 we have dividend per share 2 rupees and 40 cents. 1 share we pay 2 rupees and 40 cents. 10 million shares, how much we are paying? 24 million. So please note, share split will reduce the dividend per share. That doesn't mean the shareholder is losing. Why? Earlier shareholder has only 1 share, now he has 10 shares. For 1 share we pay 20 rupees. For 10 shares, total 10 shares, we paid 10 into 2.4, 24 rupees. So if I am a shareholder who had 1 share in 2016, how much I would have got dividend? I have only 1 share. 2016, how much dividend I would have got? 20 rupees. Now, 2020, same me, have 1 share. How much? Not 1 share. I have now 10 shares. 2016 I have 1 shares. After share split, I got 10 shares. My 10 shares, I get how much? 2 rupee 40 cents into 10 share, 24 rupees. Earlier I got 20 rupees, now I get 24 rupees. Overall my dividend have grown from 20 to 24. But when I say per share 20 to 24, I believe or I think I am losing. No. I had only 1 share at that period. Now same 1 share become 10 shares. Therefore I am getting total 24 rupees. So 24 and 20, if I compare, my dividend has grown over the 4-year period. Total point of view, the company had 1 million shares in 2016. Company paid 20 million shares, 20 million rupees dividends. 2020, company have 10 million shares and dividend 24 million. So company point of view, company paid more dividend than 2016. Shareholder point of view, he got 20 rupee dividend earlier, now he is getting 2.4 per share, but he has 10 shares, so 24 rupees he gets. So from the company point of view and customer point of view, both have got more dividends. Company paid more dividend, shareholder got more dividends. So this you have to understand before moving on to the next area. Then they have given you the market price of the company. They said average market price of share for the 11 months ending, average market price of the share for 11 months ending 250 rupees in this year, and they have excluded the March month because the March month the curfew was imposed because of COVID-19, that is from 20th March. So they take the latest date in the stock exchange, latest date share price, that is 130 rupees. So in March 2020, share price is 130. But average price in the February month, average price in February, or maybe it's average price up to February, 250. So this is your market price they are given. Further they are given you 2016 the market price are 2600, 17 2500, 2018 270. Now see the difference between 2017 and 18. 2500 rupees per share became 270. Why? Why sudden drop, significant drop? Share split. Earlier 1 share older will have how many shares now? 10 shares. So the same share value has to be divided among 10 shares. So if you are 1 shareholder earlier, now you have 10 shares. Therefore your total wealth no change. In the sense, no change in the sense your 10 shares and 1 share should have the same value. 1 share 2017 your 1 share was 2500 rupees. Assume the same share split was done in 2017. How much your share price? 2070 if you have done the share split, what was your share price? 2500 divided by 10 shares, how much? 250. So please note, if the share split was done in 2017, your share price is not 2500, that has 10 shares, share split resulted in 10 shares, 250 rupees per share. So please note, when you are comparing the market price table, 16 2600, 17 2500, 2018 270. So when you go to compare the 270 with 2017, how much you have to compare? Not 2500 with 270, 250 with 270. Why? The share split happened in 2018. So just a division of number of shares. So 2500 market price, actually speaking 250 rupees per share. Comparable, apple to apple, if you compare 2017 and 2018, comparison is 250, 270. Okay, I believe that you are getting that. Then the average P ratio over the last 5 years is 23. Average P ratio is 23. Average P ratio 23 times, and the beta coefficient of alpha company is 1.2. So beta is 1.2. Then they are given you average TB rate your TB rate is given as 5% and market premium 9%. So these are information given. I am just taking all the information available so that you understand what the question is going to be. Then going to the A part, first one, A part, calculate or ascertain the intrinsic value of a bond of 1000 rupee of alpha as at 31st March 2020 on the assumption that analysis of the term structure of the interest rate is reliable. Now earlier I took assumed amount of nominal value is 100. Actually the question says the nominal value is 1000 rupees. So if you are going to calculate your intrinsic value of a bond of 1000 on the assumption that your term structure what is available in the market for 5 years is reliable. So if your term structure is going to be reliable, what is the term structure reliability? 10%. But they are saying the market interest rates for 5-year maturities is 10%. If it is going to be 10%, they want you to calculate value of bond. Value of bond. What is your value of the intrinsic value of your bond? So how do you calculate value of bond? Calculation is present value of what? Future cash flow. Your value of a bond is always, remember, any debenture or bond, the valuation is present value of future cash flow. Even share valuation, one model is present value of future cash flow. That's a more important model, present value of future cash flow. So what is the value of the bond? They want you to calculate your present value of future cash flow. What are cash flow of your bond? Your bond, now we are talking of valuation as of when? 31st March 2020. We are here. At this date, you have to value your bond. So what are your future cash flow? You are talking about period 1 to period 12, period 10, because 5 year we have further. Each period, 6 months period, how much cash flow we are going to get? 1000 rupee bond, 1000 rupee nominal value bond, and you are going to be getting 6%, what I mentioned earlier, 6%. So period 1 to period 10, 60 rupees per period, per 6 month period. 6 month period, you are getting 60 rupees. For 1000 rupees, as an investor, you get 60. And period 10, 35 year end, you get 1000 rupees. So these are your future cash flow. If I am an investor who is buying as of 31st March 20 my bond, or this company has issued bond already in the market, so anybody who is in the market wants to value the bond, he will be getting from the future cash flow period 1 to 10, 60 rupees per 6 month period. Period 10 he gets 1000. So what is the present value of these two cash flows? Present value of these two cash flows. You need a discounting rate. What is discounting rate? 5 year instrument in the market today is trading at 10%. So please discount. You have to discount at what rate? 10% for annual rate. Your discount at 5% for per 6 month period. 5% for 6 month period. So this is your cash flow period 1 to 10. Period 10 you have 1000, 5% per 6 months. So discount all your cash flow. That's your intrinsic value of the bond. The question is asking what is the value of the bond? It's the present value of future cash flow. Firstly you have to identify what are my cash flows and what is my discounting rate. Discounting rate is, they say, the 5 year instrument in the market trading at 10%. 6 month period you are talking here, therefore your rate is 5% per 6 month period, discount at that rate. So if you go to your suggested solution, so you can see that 1077 is your value of the bond. Value of the bond is what you are getting, 1077. Your nominal value of the bond is 1000, but your market value of the bond is 1077. Please keep that in mind. We will go to the second part of the question. B part, suggest an investment strategy by comparing the market value of the bond that prevail on 31st March 2020 with your calculation made in A above. So what is the market price of the bond? 31st March 2020, what is the market price of the bond? We calculate, or we are given in the question. What is the 31st March 2020, B part of the question? 31st March 2020 market price of the bond 90%. In market, the bond is trading, even though it's insignificant volume, market that bond is trading at 90% of the nominal value. Nominal value is how much? 1000. So your market value of the bond is 900. Intrinsic value. Intrinsic is the true value of your bond. Intrinsic value of bond. How much? 1000. We calculated 1077. 1077. So what they are commenting? 1077 is the intrinsic value of the bond, whereas market that bond is trading at 900. So if you are talking about investment strategy from the investment point of view, investor point of view, 1077 is the real value, but today trading at 900. It's like certain times any market, it can be a property market, it can be government security market, it can be share market, it can be debenture market, any market certain times will be valued very low in the market, whereas your true value is very high. True value is high. So in this situation the bond is valuable 1077, but people are trading at 900. So what is investment strategy? If you are advising somebody as an investor, what are you going to say? Please buy at 900. Go and collect bonds at 900. Why? It's worth how much? 1077. So advice is to buy. Buy at 900. Why? Your bond is worth 1077. This was the advice people have given for even share market, say 1 month back. 1 month back. Everyone was talking about in the share market, the share price are very low, very low. Our share price is undervalued. Most of the good company, very good company, performance are good, management is good, all that good, and future is all good. Still valuing at very low rates, low values, low P ratio, less net asset basis valuation, very low valuation. Because the corona has affected the businesses and future is not very much certain, so people are value very low. But their true value is like this, very much higher. So 1 month back, people are advising people to buy shares. People were asking to buy shares. Now today you can see that last 3 weeks or 2 weeks, you can see the market has been growing slowly up and up. Now it's at a very good rate. People have been buying and people are still making money out of it. People who bought it 1 month back would be laughing now because the prices are very high. So even in this example, your bond is worth 1077, but in the market today trading at 900. So what is the advice you are telling? Please go and buy at 900, accumulate the bond. Why? It's worth 1077. Even if you say it's not worth 1077, what is your nominal value of the bond? 1000 rupees. So you buy at 900, hold it till maturity, you get 1000 rupees. So you are not going to lose money. The advice is to buy at 900 so that you have a very good gain to appreciate. Gain to appreciate. So your answer is there. Advice is to buy the bonds. C part. C part, ascertain the intrinsic value of a bond as at 31st March 2022. Now again I told you, the examiner is interested about whether you understand your time value of money calculations. 2022 you are asked to value the same bond like what we did, value of the bond not at 2020, you are asked to calculate the value of the bond in 2022. Assuming that interest rate applicable for financial assets maturing within 3 years would be 15%. Now your market rate is not at 10%. The similar assets in the market is earning at 15%. So anybody who is going to buy the instrument, he would be looking for 15% return from the instrument what you are holding already, or the bond what is traded in the market. So since the market interest rates are at 15% for 3-year maturity, even this bond whoever is going to buy, because it has 3 years further to go, 2025 its maturity. So 2022 when you are going to buy, 3 years you have still. So this bond, what is the value? What is the true value? Intrinsic value. Intrinsic value. Intrinsic value is how much? But again, present value of future cash flow. Since it's 3-year period, period 1 to period 6, your 60 rupees is your coupon interest. Every 6 months you get coupon interest of 60 rupees. There is no change because of market interest are changing. The bond rate will not change. Bond coupon rate same 60 you get for period 1 to 6. Period 6, how much you get? 1000 rupees. This is your future cash flow. You are discount. At what rate you are discount? Similar instrument in the market, 3-year maturity is trading at 15%. Trading at 15%. So your 6-month interest rate is how much? 7.5%. 7.5%. So if it is 7.5% for 6 months, you discount this cash flow at this rate. That will give you the intrinsic value. So you can see the value of the bond, 929.59. The value of the bond is 929.59. So now see the difference. Earlier when we valued the bond in 2020 at 10% rate, your value of the bond was 1077, which is more than your nominal value. Now after 2 years, your market rates have changed. At that time when you go to value the bond, your value is worth 929, even not 1000 rupees. So now the worth of the bond is 929, not 1077 when you value the bond in 2020. So please keep in mind that these are simply discounting thing. This present value of your future cash flows will be your value of the bond. Only thing, the coupon rate is not annually paid, every 6 months. Therefore, you have to calculate your cash flow as 6-month cash flow. 6-month cash flow, not annual cash flow, 6-month cash flow. Therefore, your discounting rate also has to be not 1-year rate, 6-month rate. D part. If you read the D part, D part of the question, explain the significance of risk and return to an investor, significance of risk and return to an investor who bought bonds of alpha on 31st March 2020 and intends to hold them until maturity. So we are talking about 31st March 2020, an investor who is going to buy the bond. Investor who is going to buy the bond. As of 2020 March, earlier they said, the market rates are going to be at 10% levels. There is a reliability. That's one side of the story, 10%. So if the investor is going to, please understand, if the investor is going to buy thinking that 10% rate will prevail, 10% rate will be prevailing, then your bond, what you are buying, will be giving you return higher. If you are going to have a market situation where the market rate is going to be 10%, then your bond, what you are going to buy, give you a higher return. Why? Your return is 12%. So you are benefiting out of it. On the other hand, if the interest rates in the market going to 20%, they mentioned that there is a possibility that rate can go upward. So when the rate goes to even say 20, not 20, even 15, 16, then your bond, what you are going to hold, is going to give you a lower rate. Why? Until your maturity, you will be getting a coupon rate of how much? 12%. So please note that if the rate in the market is 10%, you are benefiting. Why? Your bond is giving you 12%. But if the market rate is at 15, 20 or like higher rates, your bond what you are having is giving you 12%. In that case, you are going to be losing the return from the investment. If the rates are going to be 10%, your risk is going to be lower, while you are getting a better return. But if you are going to have a 20%, your risk is higher, your value will drop. Even though till maturity you are holding it, if you are going to sell it in between, you will lose money because your rates are very high in the market. So that's basically the D part of the question. Then the E part. What is E part? E part, now up to now what we looked at here, bond valuation. We looked at bond valuation. Now we are going to share valuation. your E part is about share valuation. E part. What is the question? Calculate the value of a share of alpha by using dividend growth and earning growth model. Dividend growth and earning growth model. Generally, it's a dividend growth model we use, right? The question is asking you to calculate value even using earning growth model. So, end of the day, what they want is you to take the dividend growth one or earning growth the other one. Use a simple average of growth over the applicable period. They don't want you the compounding rate, but it's very not what I would say, it's not the right thing, because financial management is about compounding rate calculation. But examiner, for some simplification, they have said simple interest you can use to calculate simple growth of earning or dividend. So, you have to calculate the value of the share, Two ways they are asking, one is dividend growth model, other one is earning growth model. So, we say dividend growth model. Dividend growth model, your formula is DEO 1 plus G R minus G. So, this is your dividend growth model formula, DEO 1 plus G R minus G. So, what is your D? 2.4 I believe. Your dividend is 2 rupees and 40 cents, 2 rupees and 40 cents last year. 1 plus growth we have to calculate, R minus G. R is the required rate of return. Please understand, it is your required rate of return which is equal to cost of equity. Required rate of return of the investor is equal to company cost of equity. So, we can use that R with the R of the investor or cost of equity company. Since the information has been given, cost of equity can be calculated using CAPM model, risk-free rate plus beta, market return minus risk-free rate. So, risk-free rate is given as 5%, beta is given as 1.2 multiplied by, this is risk premium 9%. So, you know that it is 15.8%. So, this is your cost of equity. Cost of equity is 15.8%. So, you can mention that 15.8 minus your growth rate again. So, this is your cost of equity calculator using CAPM model, risk-free rate plus beta, market return minus risk-free, that is 15.8%, that minus growth rate, So, growth rate we have to calculate, As I mentioned at the beginning, the share split happened in 2018. So, when you take the dividend table, you can see your 2016 dividend was 2 rupees and 2020 your dividend was 2.4. So, 40% or 20% your growth, 20% dividend growth was there. Your formula we will calculate 2.4, 1 plus growth rate we have to put, 15.8 minus growth rate. So, what is the growth? 2 rupee and 40 cents minus 2 rupee dividend divided by these 40 cents. The 40 cents is, you can say 40 cents is 20% growth for 4 years. Why? 2 rupee dividend in 2016, 2.4 in 2020. So, the 40 cents dividend growth was for the 2 rupee dividend in 2016. That means 20% has grown over the 4 year period. 4 year period 20%. So, what is average return, average growth per annum? 5% per annum. So, 5% is 0.05, that gives you the value of the share. They calculated 23.33. This is a dividend growth model based valuation of a share. Dividend growth based valuation 23.33. So, that is your dividend growth model valuation of a share 31st March 2020. DEO was 2.4 we have been given, growth rate we calculated, 5%, simple average we have calculated, and we calculate the value of the share is 23.33. This is dividend growth model. Earning growth we have to calculate. So, please note, you need to find out the earnings, Actually, I understand there is a slight mistake in the earning calculation, because you have been given a table. If you look at your table, 2016 to 2020 your retained earnings are given. So, retained earnings plus your current year profits and dividends will retained earning brought forward, profits, then you minus dividend, then retained earning carried forward. This is how the normal format. So, if you take the 2016, 17, 18, 19 and 20, right. So, 16 your retained earning is 600,000, that is here 600 million. 2017 they told you 2017 your retained earning carried forward is 689, 2017 is 689 and 2017 689, 2018 767, 2019 869, 2020 1045. This is your retained earning carried forward amount. As per your table, these are retained earning carried forward. And they have given you the dividend amount. They have given you dividend amount 2016 20 rupees. At that time we said only 1 million shares a company had, 1 million shares only. So 20 rupee dividend you have paid in 2016. So we can go backward. If you want, you can say 20 million dividend the company has paid and profits had been told as 100. So you can calculate it. These are two 620, that means you have 520 million brought forward. So from that you minus 20, you got 600 million. I am just putting the table back again. 2017 21 rupees, that means 21 million dividend. 2018 22 rupees per dividend, 22 million. 2019 2 rupees and 30, but you have 10 million shares, that means 23 million. 24 million last year. So these are dividend what you paid. So again going back, retained earning carried forward 600, brought forward 600. And you are talking about 689, that means 689 after dividend of 21 million, 710 million. 710 million, that means 110 million profits. 110 million profit. 710 you minus 21 million, then you get 689 million. Again 689 you have brought forward 22 million, 789 million, that means 100 million profits. 2019 869 after dividend of 23, that means 892 million. 892 million. So your 2019 you brought forward is 767. $869, 892, 892 means this is 125. 125. Last year 1045, this brought forward goes here 869. 1045 is your carried forward 24 million, that means 1069 million, 200 million. This is your profits calculation for the last 5 years. There is a slight mistake in the suggested answer, so I would rather recommend you to look at these numbers. This is basically your earnings. So what we want is the earning growth. Earning growth. What you do? Your 100 million profit has become 200 million. 100 million profit has become 200 million. That means 100 million has become 200 million. It's 100% growth. 100% growth. So 100% growth for how long? 1 year, 2 years, 3 years, 4 years. That means you are talking about 25% growth rate. 25% per annum growth rate. 25% per annum growth rate. So when you are going to value the share, same model, same dividend growth model, instead of dividend, we will use the earnings. So if you are talking about 2020 your earnings is 200 million, 10 million shares, which means 20 rupees. 200 million earnings or 200 million profits, 10 million shares, you are talking about 20 rupees per share, 1 plus growth rate 25%, 1 plus 25%, then your R minus G, so you will calculate your earning growth. Here the earning growth is 25% if you take a simple average, but the problem is like your R has to be always more than growth rate. Your growth rate cannot be more than R, right? If it is R is more than G or G is more than R, this formula cannot give you the value. Okay, so keep that in mind, right? So if you are going by the suggested answer, right? So it's not correct in terms of earning calculation, right? If you simply go by the amounts given, it's basically give you a value of 265 rupees, earning based model, and dividend growth model gives you earlier what we calculated, I think it was 23 something. So your dividend based valuation gives you 23 rupees, right? And your earning based valuation, even though it's not right numbers, right? Simply if you look at the dividend based valuation 25, 23 point something, and earning based it's some 265 rupees. This is your market value of the share. So given the numbers, assuming it's right numbers, you are getting a value of 265 for earnings, and other one you are getting the 23 rupees dividend based valuation. And F part, comment on the value of the share based on your calculation made in E above. Comment on the share value based on the calculation made above. So if you take the dividend based valuation, it's 23 rupees. Earning based valuation, it's higher value. But in my calculation, you cannot be calculating because your growth rate is higher. But if you are going by the suggested answer, it is 265. So what you are trying to say is, since your company growth, earning growth, according to the suggested answer, earning growth is 10%. Since earning growth is 10% and dividend growth is 5%, dividend growth at 5%, earning growth at 10%. Since the earning growth is better, 10%, you might be reinvesting your money in your business to generate more return for shareholder. So the answer is that you are able to invest in your business, earn more return for shareholder. So that's something you can do. So that's basically whether the numbers are right or wrong, still the answer on that is correct, in the sense like your growth rate, if the earning growth is better than your dividend growth, it's better that you invest most of the money in your business and generate more return for shareholder, because at the end of the day shareholder wants their value creation. Then the G part, provide your recommendation with reason concerning investment in shares on Alpha PLC on the relative PE of the company. On the relative PE of the company. On the relative PE ratio of the company. So the last part, it's about value of your share based on PE. So what was average PE they are talking about? Average PE, the industry or this company, if you look at the average PE ratio of the industry is 23 times. Average PE ratio 23 times. And if you take the earning per share of the company 2020, it is, in my calculation it was 20 rupees. But suggested answer as 14 rupees or something, right? Your earning per share, yeah, to 14 rupees. So if you say 20 rupees and market price. So what is your market price? Your market price 31st March, where the COVID-19 impacted share market was closed, your share price what they are saving is 130 rupees. last traded price was 130 in 20th March. If it is 130, your EPS is 20, your PE ratio, implied PE ratio is 6.5 times. And if the suggested answer number if you take, right, it is 14, say market price 130, we are talking about less than 10 times, less than or 9 times. So at the market price of 130, we are somewhere 6.5 or 9 times, whatever number. But the industry had been trading at 23 times. So what we are trying to say, the market price has drastically dropped. If you compare the 2019 price, 2019 price is 300. 2019 price is 300. So 2019 price of 300 has fallen into 130. True that this is an exceptional scenario where the COVID-19 impacted. But if you take the 11 months average price, 11 months average price in the question is I think 250, if I am not right. Yeah, average price was 250 for 11 months. So if you take 250 is your price, it is in my number 20, it's around 12.5 P ratio, and if it is a 14, you are talking about at least 16, 17 times. So anyway, it is below the 23 times. It's below the 23 times. What we are trying to say here, average PE ratio of the industry was 23 times, but your share had been trading. At now, of course, the COVID period, it's a very bad. So we should not take that situation because it's a very exceptional situation. But even up to February, even at my higher earning per share, your PE ratio is 12.5, but maybe at the 14 rupee earning per share, your PE was at 16, 17 times, which is less than 23 times. So what we have to tell as a comment, the company shares had been trading at a lower PE ratio than in the past. So it's a negative situation. On the other side, if there are anyone who wants to buy, assuming that company performs well, somebody come and buy the shares at a lower PE because there is a higher potential for the share price to go up. So that's something we can comment about for the last part. So there is an opportunity for anybody to buy shares at this PE ratio because the share price, very higher tendency for the share price to go up. Then the last part, H part. H part, explain whether Alpha PLC was able to achieve the objective of the share split made in 2018. What is share split? We said in 2018 company gave 10 shares for 1 share. Generally the objective of share split is to increase volume or increase liquidity of the shares. Increase liquidity of the shares, that's nothing else. So that you have more liquidity in the market, more people will buy and sell your shares, so that's basically the idea. Theoretically there is no reason why the share price should go up for the share split, theoretically. But still the share price can go up in the market because when there is a demand for some shares, share price goes up. But theoretically no earnings change, no cash flow change, so there is no net assets change, so there is no way the share price can go up when you do share split because it's a book exercise. You get a company secretary department to give issue shares for 1 share, cancel 1 share, put 10 shares. Just because you do that, share price cannot go up. That means wealth cannot change, So objective of the share split is to increase the liquidity of the shares in the market so that more people trade your shares. If you say your share price is 2000 rupees, very little people can come and buy. But when you have 20 rupee shares, a lot of people come and buy. So because it's small amount, people can buy and sell shares. So therefore the increasing liquidity is the only objective of the share split. Question is asking whether your objective achieved. Your objective achieved. And at the same time they have said was able to achieve the objective. Going back to your question. You can read it. One of the main objectives of share split was to increase the liquidity and to create value for shareholder. To be honest, the creating value for shareholder cannot happen from the share split. Share split is a theoretically you have to understand it's an administrative job. The share split cannot create wealth for shareholder, but the company had an objective to create wealth for shareholder. Assuming they can do that, they issue share split. So the objective is to increase the liquidity, and in this case, they are talking about creating wealth. Okay. So volume related stuff, we can't comment, we don't know any numbers of the volume, but creating wealth point of view we can comment. What's the comment? 2000 your share price, if you look at 2017 your share price 2500, 2017 share price 2500, 2018 your share price 270, 2019 300. So please note your 2005 or 2017 your 2500, which is actually 250. Why? The share split, if you are going to compare 270, the apple to apple comparison is 250. So 250 has become 270 in 2018, 300 in 2019. 2020, what happened? Your average price for 11 months 250. Closing price in March, how much? 130. Even if you say 130 is a very exceptional price, it should not be compared for reason of comparison. We take the 250, which is more reasonable for 11 months average. So 250 rupees share, 2018 when we did the share split 270. So 270 in 2018 has come down to 250. So if the company Alpha had objective of creating wealth for shareholder, have they achieved the objective of wealth creation? Even at the average price, have they created wealth? No. 2020 March, if you take 130, no way they have created wealth. But at least if you take the, on a favorable side, you take 250, you have not created wealth. That's basically the answer for last part. So please note that this question, the question number 2, had two main parts. One is on the bond valuation, other one is on the share valuation. Bond valuation is talking about simple principles of bond valuation, calculating the value of the bond, not only as of a one date, another day also they ask when the market rates are changing. 10% rates one time, another time 15%, they want the value of the bond at 2 times. And they want an investment strategy for any investor when the bond is trading at a lower value, whereas it has intrinsic value. What do you do? Simple answer, recommend to buy. So those are the bond related questions we looked at. Then the second part of the question is about share valuation, where they wanted you to value using a method of dividend based valuation and the earning growth method. In that case, we have taken CAPM based valuation or CAPM based cost of equity calculation. All of you would have said risk free rate plus beta market premium. So that's basically giving you an idea of how to value a share using dividend growth model. And they are given you a dividend earning growth calculation also. So that is again using the earning growth model. That is dividend growth model. Instead of dividend growth, you mention earning growth. Only thing that the table had a difference in earnings, so we had to show both sides of it, so you can value it. So don't get confused with the numbers. See whether you are clear about this theory of how to calculate the values. And again, finally, they want a share split confusion to see whether it's worth it or not worth it. The share split has objective of these two, and those first objective we can't comment much because there is no volume information. Second objective, which is generally can't be objective, but here they are given as objective, can be achieved or not achieved, can't be achieved because their value is 130 or 250, whereas it was 270 in 2018, so you have not achieved the objective of share split. That's basically the last part. I believe those are giving you some knowledge on what are the area tested in the 1 and 2, and the pre-seen or the third part of the question we will attempt on the next session. Thank you.